Hello and welcome to our end of March update from the Wealthy Doctor Institute. Intelligent investing for the busy professional. We focus on simple battle-tested methods of investing that require just one adjustment each month to protect and build wealth. I'm David Day, author of my book, The Busy Doctor's Investment Guide, How One Adjustment Per Month Can Save and Maintain Your Portfolio's Health. Although the strategies in this book are easy to calculate and adjust each month, for those of you who are new to the concepts in this book, or for those of you who are new to investing in general, feel free to follow along until you get the hang of it. So this month's video, we'll go over questions of the month. There's a few questions that keep coming up over and over again. Then we'll review the 20-month moving average signal of the month. Then we'll review the MRI adjustment of the month, and then we'll review briefly the 25% trailing stop loss system. So, common questions, and I'll group them together just because they're all kind of related. Why don't I take into account current events or other factors, especially concerning, take your pick, war, terrorism, elections, economy, skirt length, PE ratios, and what about real estate? The reason why I'd like to bundle all these questions together is that these are more philosophical questions. Practically speaking, if you take a look at my systems, I only take one or two relevant pieces of data and use those as indicators. Remember, every time you look at news, every time you look at the chart, anytime you hear someone's opinion, you're basically getting some data that you think is actionable. When in reality, a lot of that data out there, if you try to invest with it, even on backtesting, they're not that consistent. At least I have yet to find a system that is consistent. For instance, let me give you an example of a stock chart. This is a stock chart that we're very familiar with, the S&P 500 index. I purposely did not give you the date range. So if current events are so useful at predicting market behavior, let me ask you, where was 9/11? Probably one of the most significant events in the last century. If you guess right here, you'd be correct. But wait a minute, didn't stocks fall because of 9/11? Well, no, remember, stocks were falling since March of 2000. So by the time September 2001 came along, we've already had much of a downtrend. In fact, if you remember, stocks were closed for 1 week, and then maybe one more week it went down before it bounced up. So that's kind of counterintuitive that something like 9/11 would actually bounce up, if anything, not really change the market direction. So here's another question. Where was the Enron bankruptcy? If you guessed here, you'd be right. But wait a minute. Didn't Enron declare bankruptcy as well as all these other companies, and that's why stock markets were going down? Or actually, Enron declared bankruptcy just happens to be at the end of the bear market. So if I gave you another significant current event news, the start of Desert Storm, that second Iraq war, it started right here. So this was where, paradoxically, we are all thinking war is bad for the economy, therefore the markets tend to go down during war. No, actually, in this case, war was the start of a multi-year bull market. So now I've already shown you that current events have little, if not counterintuitive, effects on the markets. So to use current events as an indicator to trade the markets is not very reliable. But what about something like PE ratio? I'm going to single out PE ratio just because this is by far the most common question people ask me about. Well, what happens if the PE ratio is too high or too low? Well, let me ask you something. Are you talking about the forecasted PE ratio, which is notoriously inaccurate, or are we talking about the lagging historical P ratio, which is accurate, but obviously lagging. Is there any system that you can come up with that uses P ratio as a primary indicator to make a decision whether or not to be in or out of the markets? I would contend that there are no reliable trading systems based on P ratio. It's an interesting factoid, but not relevant and not accurate in terms of long-term or short-term trading. Well, how about real estate? Real estate, we can invest in real estate through real estate investment trusts, REITs. They can be traded on the markets just like any other stock or ETF. In general, real estate goes up when stocks go up and goes down when stocks go down. The correlation isn't that tight, but it's tight enough that there really isn't that much advantage switching one from the other, in other words. But how about real estate in general? How about rental property? Well, I'll be the first to tell you I'm not an expert in real estate. For me, there are risks involved in real estate that I'm not comfortable with. Just like how when I talk to people who actually are very successful in real estate investing, they have concerns about stock market investments that they're not comfortable with. And, to each their own. And there is a interesting story I'd like to share with you. Around 12 years ago, I went to this real estate seminar where part of the seminar, they gave us a personality test. And it's one of those personality tests where they split into 4 quadrants and you figure out where you are. And there's one quadrant that was the introvert. Someone who was socially quiet, but they're very fastidious about the data. And guess what? Out of 100 attendees, only 4 people raised their hands who were introverts. Well, guess who I was? So I was curious. I took the same personality test and I brought it over to our options trading club that met the following month. And I gave the test to our members. And curiously, 55% of the options traders in our clubs were introverts. So the takeaway lesson from that would be we tend to gravitate towards what we're comfortable with. And what we're comfortable with tends to be in alignment with our personality. But that doesn't mean that you're stuck. I mean, again, just because 55% were introverts means that 45% were not. And again, there were 4 people in that real estate seminar, which means that there are introverts who do real estate. Whatever you put your mind to mastering will serve you well. So if you want to do real estate, don't come to me. Go to someone who has done real estate successfully, and if you can get them to share information with you, that'll help you avoid a lot of common beginner mistakes. Alright, so on to our systems. The first system that we'll go over is the 20-month simple moving average system, abbreviated 20-month SMA. It's just a one-rule system. If the price of the S&P 500 index fund is above the 20-month moving average, it's relatively safe to be invested in the index fund. Otherwise, get out. So what's the stock chart say this month? Well, the VFINX, which is the ticker symbol of the S&P 500 index fund, that's Vanguard. It's a low-cost fund that has the most data. That's why I like to use it for backtesting. It ended this month at 189.99 compared to the 20-month moving average 185.49. So the index is now above the SMA. It's relatively safe to be back in stocks. Now, if you notice that within the last few months since August, we've whipsawed once already, and now here's a second whipsaw. We've only been out of the markets a couple of months. Yeah, this is unusual. If you take a look at the last 2 years, the stocks have been relatively flat, but it's been violently flat, going up and down, trying to decide on the market direction. If you take a look at historically, trends tend to be strong. They tend to be clearly up or clearly down, or fairly clearly when you take a look at the long-term structure. Has stocks gone sideways in the past? Yes, I mean, for instance, over here in 2003 it did go sideways, but it was relatively calm. It wasn't violently up and down like how it's been recently. So when stocks have a clear trend up, clear trend down, or is relatively calm in the sideways direction, this system works. When it's volatile sideways, this is the one condition where this system has a weakness. Every system has a weakness, and that's because of the nature of the markets. It can do many different things, has many characteristics depending on time and cycle. So no system is perfect, and this system has its weakness. So going along with the system, this model is buying the S&P 500 index fund this month. Next system is the monthly rotation investment system, abbreviated MRI. So the MRI rules is completely different from the SMA rule. You have three mutual funds: the S&P 500 index fund, the emerging markets fund, and the inverse fund. Every month, rank these three funds, sell the bottom 25% of your portfolio, and use it to buy the top fund that you calculate up here. So how do we do this month? If you take a look at the blue line, which is the S&P 500 index fund, the red emerging markets fund, and the green inverse fund, you find that the index fund went up 6.2%. Here we go, 6.2. The inverse one went minus 6.4%. So they're mirror images. But then this month, the emerging markets went up 12.9%. So this month there is a clear winner. It's the emerging markets fund. So what do we do with this data? Last month, we were roughly half in the inverse fund, half in the index fund. In other words, one inverse cancels out one index. We were roughly 100% in cash. This month, if we were to sell the bottom 25%, which is the inverse fund, and use it to buy the emerging markets fund, one of these turns into one of these, we're roughly 25% inverse fund, 25% emerging markets, and 50% index fund. And if you see that one index fund cancels out one inverse fund, that means we're roughly 50% cash, 25% emerging markets, and 25% index fund. So here we are in the model. Next system, again, a completely different system. Just to remind ourselves what this system is the 1% risk trailing stop system using a 25% trailing stop. This is a system that we use to deal with stock tips. Just to go over their system, if you really want to buy a stock, limit risk to only 1% of your portfolio. Remember, stocks have idiosyncratic risk. These are ones that really do react to news, but stock-specific news. So that's why, since each stock has their own unique risk characteristics, we don't want any one stock to affect more than 1% of our portfolio. Just keep in mind, keep an eye on your stocks if you're in this system at least once a month, ideally more once a week, just to make sure that your stop losses did trigger when they were supposed to. In summary, remember there are all different systems. Keep them separate, don't mix them up. If you mix up systems or you disregard rules of a system, you don't have a system. We went over three different systems: the 20-month moving average system, the MRI system, and the basics of dealing with stock tips. So questions? Keep those questions coming. I know I talked to several of you personally each month, and for some of you who have only heard me indirectly, maybe you got a copy of this video from a well-meaning colleague or friend, here are ways to get in contact with me. Drop me a line, send me email, call me, set up a consult. Some of you I've talked to, you know your stuff. I'm not worried about you. But some other people, oh boy, lucky you called me, or lucky we've talked. Sometimes it's awkward to admit that you don't know something, but getting this handled earlier rather than later saves a lot of heartache later. So don't be bashful. The more you delay, the more time is against you. So, until next month, invest safely.